audience, but I know they're talking to undecided people, but you guys are totally decided folks here, okay? Because you know what you want. Okay, so I'm happy that the decided folks are sitting over here, so then I don't feel all that bad about them taking some of our audience away tonight. Anyway, how many of you don't know about TIE? Awesome, my job is done. Everybody knows about TIE. So this is great, but again, just like anything else, the reason, we go to our, the favorite institutions, on a periodic basis, just so that we can get ourselves refreshed. If nothing, is just a reminder why are we here. So let me just mention just few words about TIE. TIE was created 20 years ago right here in Silicon Valley by a group of people who had their roots in the South Asian countries. And they came with nothing else but just having good head on the shoulder, good attitude, good work ethic, and they made it big in America. And they they banded together here and said, gee, won't that be nice if we form a society and help anybody who wants to succeed as entrepreneurs or as business executives. And that mission of TIE has not changed since day one. The core of this are, again, those successful people who are also very generous, and we call them our TIE charter members, and many of them in the audience, so I want to just say thank you for all of you to be over here. If I can have a show of hands just to see how many CMs are here, that would be awesome. I mean, you're a CM, raise your hand. There you go, all right. Okay, very good. We got, we got some CMs, okay. Those undecided guys are watching the debate, okay. All right. Then, because the charter members are, highly successful and highly generous, so we go through a process of vetting them and bringing them on board. Success could be verified because you are an entrepreneur, we all know what you've done, you are a business executive at Cisco or Intel or Google or whatever, we can very easily verify. But what is hard to verify is your generosity. So that's why we spend more time, you are successful, but if you're not generous, then maybe perhaps you don't belong to TIE because you're not quite ready yet, okay? But in our situation, 300 such people who live in Silicon Valley who are our charter members, they all passed the test. They are highly successful, highly generous. So thank you to charter members for that. Now they serve as an attractant because who doesn't want successful people like generous people to be around them, right? So they attract all our broader audience, and we call them loosely our members. And I know many of you are members tonight, and thank you for taking advantage of the generous offer that our membership committee, Naveen Best in particular, and Paul Singh, and Raj Desai, and Ashok Ramaswamy came up with. That we say, if you're a member, fine, okay, this is on us, at least for this quarter. So from October 1 through December 31st, take advantage of it. You don't have to pay for the dinner, and you can still get all the quality, programs like this, wonderful panel like that, and the words of wisdom. So it's a huge investment. At no cost to you, you get to enjoy all that kind of stuff. And hopefully, more of you who are not yet members yet, just a guest, please become a member. I think you really see there's all kind of awesome benefits that we have. And then we have another constituency, which is called our sponsors. And many of the sponsors are in the hall. If I can just have a raise of hand, I know Stan, I see you sitting over there. He's from Morgan Stanley Smith Barney. Of course, our the Morrison Foster, they organize the stuff. So thank you very much for really having you over here. But our sponsors basically are the top flight venture capital firms, the top flight corporations, the top flight law firms, the top flight accounting firms, and top flight bankers. They basically really constitute our sponsor base. And so why do they want to sponsor us? Very simple. A, they kind of hang out with this dynamic combination. Okay, the core is the charter member, and then the electrons are all the members kind of spinning around them. And these guys say, hey, let's come and encapsulate you and give you some cash. Okay, so that's how the sponsor come get attracted to us. Okay, they just kind of keep us totally compacted inside. So thank you very much. And we have if you pay attention, we have a chart that we can running around. But just to mention the top corporations, we have IBM forever, our sponsor. We have HP, we got Ericsson, we got SAP. Actually, they've been sponsored for many years, but this year they came as a grand sponsor for Tycon. I mean, they wrote us a $100,000 check. So you see, the importance of the sponsors. So we have a lot of, Emirates Airlines, Ernst & Young as an accounting firm, KPMG for the longest time, Silicon Valley Bank. List just goes on, and law firms, of course, Morrison Foster. Okay, what can we say? Many years ago, we brought these folks on board, and you've been just just wonderful supporter. Then there's another constituency, which is the fourth one, which is called, which actually is a combination of all the three, which we call our volunteers, because whatever we do at TIE with a very small staff, and Radhesai, where are you? Oh, yeah. Oh, just stand up, please. So Radhesai is our executive director of TIE. He's been involved with TIE pretty much since inception, okay? And he has a mighty staff, small but mighty, of 3 people. But then we have the 300-400 volunteers. They help put all these programs together, and they come from our sponsor community, our charter member community, our member community. And that's how we make all the wonderful programming possible, because if we did not have the support of everybody else, we just cannot succeed. So in one situation, TIE is actually, this is the volunteerism is the best. There are many other organizations, trade associations, industry associations, you name it, professional associations. But the way TIE works is because of the volunteerism. So salute to all the volunteers, and without that, nothing will be possible. And then, like even today, you saw, people are greeting you, at the registration desk. Dan Dalal talking over here. He's our permanent, God knows probably 15 years, audio-visual. He's the director, he's our media director, producer, he records everything, he tries to broadcast everything, he puts up with all our shenanigans and nonsenses, and without complaint. So Dan, salute to you. Thank you very much for really behind the scene and sometimes on the front stage doing a great job. Anyway, so without much further ado, welcome you again, and I'm going to introduce our host, Naveen Best, or Shailesh, who is going to come and introduce the panel? Why don't you guys, Naveen, by the way, Naveen is, he's our program chair. And something I have to say about Naveen, we do 60 programs a year. 100 people on the average show up for each program. So we have 6,000 people come to the programs through Naveen's effort. And of course, with TICON, about 4,000 people come. So no other organization has 10,000 people physically sitting face to face, eyeball to eyeball, and talking about business entrepreneurship, okay? We got social media, we do all that. We have Facebook, we have Twitter, we do all that. But the reality is nothing better than when people are sitting together, eyeball to eyeball, face to face, doing business and mingling and doing wonderful things. So Shailesh, come on board, please, and thank you for a great job. Shailesh is a general manager and vice president at Cisco, and thank you for all your work.
Vish, absolutely. Thank you. Vish is a really animated person, as you can see, right? So, I just wanted to spend a couple of minutes talking about what Growth Company Forum is. So I'm the chairperson for Growth Company Forum, which is one of many forums that TIE has. Now, as you know, TIE, the Indus Entrepreneurs, is obviously all about entrepreneurs. So it has been set up and is really structured to help early stage companies, founders, get going, to find the angel investors, to find investors around Series A and so on. But what we found, about 3-4 years ago, is that there was no forum that was dedicated to helping companies which are mid-stage, late stage, to look at what I would call as issues associated with growing a company. So that means things such as IPOs, governance, M&A, domestic as well as cross-border, things such as spin-offs or spin-outs, or things such as spin-ins, which is very popular among entrepreneurs. So we really set this up in 2009 to focus on those issues, create the right kind of programs, to provide the right kind of resources for this. And it has been very successful over the last 3-4 years. We typically host about 4 events every year, and we've had the pleasure of having some very distinguished folks join our panel discussions. So, and we have a great set that has been organized for today, and that has been done with courtesy of Morrison & Foerster, specifically Chuck Comey. So what I'd like to do today is introduce Chuck a little bit, and he has a really wonderful background. And then I'll leave it to Chuck to introduce the panel and to take this forward. So let me read this. It's actually really impressive. Chuck is a corporate finance partner in Morrison & Foerster's Palo Alto office, who specializes in cross-border M&A and investment transactions. and this is where it gets really interesting. Before relocating to Silicon Valley in July 2010, Mr. Comey opened and served as the managing partner of the firm's Shanghai office for 7 years, and worked on the ground in China and Japan for a total of 16 years. In fact, some of the big deals that are in the newspapers these days, Chuck and his firm are a part of. He advises clients on cross-border mergers and acquisitions, strategic alliances, venture capital, and private equity financing. He speaks and reads Mandarin, so if you want to practice your Mandarin, you can do that. Mr. Comey is recommended as a leading lawyer by Chambers Global 2012, Chambers Asia, and so on. Recent transactions that Chuck has led, including representing Intel earlier this year in several acquisitions in Asia and North America, and Oak Investment Partners and NEA in American Express strategic investment in Chinese mobile payment provider Lian Pay. Did I say that right? It's great. So, Chuck, thank you so much for joining, and I also want to thank all of you for coming here. And as Vish said earlier, you are the truly decided ones. Now, Chuck, this also makes your job a little harder. You have to provide more entertainment and more thought-provoking remarks and discussions than what those two are providing.
We'll do our best. Thanks very much, Shailesh. And let me just on this election night or pre-election night add my welcome to all of you for taking time to be with us for what I think is going to be a very interesting and lively panel discussion, which is around really I think a topic that's on a lot of people's minds in this room, which is the exit. And how do I structure that exit? How do I make it happen? When should I make it happen? And what are the key success factors in execution? And so we hope to cover that with a great set of founders, experienced founders that have been through the process very recently, and then some experts that work regularly in this context. Our firm does a lot of M&A. We're really a leader in the M&A market. We work with companies like SoftBank, and the deal announced yesterday, tendering for Sprint, which is the largest outbound deal from Asia ever. It's the largest deal in Japan's history, and I think it's the largest deal in the U.S. this year. Working with companies like Intel in serial acquisitions, and then on the sell side, helping companies sell themselves. Founders and boards, the funds that work with them. So, for example, the sale of Gizmo 5 Technologies to Google, Mykonos when it was sold to Juniper Networks, Linka Media when it was sold to Hynix, and those last two deals my colleague Bill Che did, and he can tell you more about that. Apart from the transactional side, we do a lot in IP and litigation, and there was a very high-profile litigation here in the Bay Area that we were happily involved in, that you probably read about in the newspaper. But most importantly, we have a significant, deep expertise from our panel members. And let me just, before we go into a program, have them each say a word about themselves and their firms. First, Christian.
Hi, I'm Christian Bennett with Pagewell Partners. I'm one of the 9 managing directors in our business. We're a group of 27 professionals focused solely on sell-side M&A. We ourselves were recently acquired at the end of last year by a global investment bank called Duff & Phelps. And so we're the technology investment banking group within Duff & Phelps. We focus on the middle market technology space. We do deals primarily between value between 20 million and 500 million. We do about 30 a year. So we're very active in the space and have lots of relevant experience. I personally have closed 7 deals so far this year, and I have 3 in LOI, which is a record for myself.
Tessa.
Hi everyone, thanks for having us. My name is Tessa Schwartz. I'm a partner in our San Francisco office of Morrison & Forster, and I am a technology IP attorney. And what that means for you is that I spend a lot of time on M&A deals trying to get people ready by having their IP lined up, having their contracts ready to go, and I'll talk to you about that tonight. And then helping serial acquirers like Intel and Yahoo. We'll see. I'm sure there'll be some interesting activity this year with them, and a lot of other names in the Bay Area, on their deals. One of the things that MoFo, I think, does a little bit differently from other M&A shops is that all of our technology IP lawyers have kind of destination standalone practices. So we do the complex licensing arrangements and commercial agreements, collaborations, et cetera. So when we are helping people get ready for M&A and doing those deals, we bring that expertise to bear. And so thank you for having us, and we'll give you our tips later on to keep you out of trouble.
Rob.
Hi, my name is Nirav Berry. I am with BlackBerry. So, given my last name, you can imagine why I'm with that company. I got to RIM via an acquisition. They acquired my company called Cellmania 2 years ago, and it was a nice exit. The company was 10 years old, profitable. And I'll explain some of the deal dynamics, but that's why I'm on the panel to talk about, from a founder perspective, what an M&A is like.
Hi, my name is Kampal Shankar, and I'm getting over a little cold, so I apologize if I not in well. I was the founder and CEO of a company called Silicon Blue. It was a chip company, which was acquired by Lattice Semiconductor in December of last year. And I was with Lattice through the assimilation process through August, and I assimilated the company, and I am now freelancing around right now. And would love to tell you about how the acquisition happened.
Bill.
Hi, my name is Bill Che. I'm a corporate M&A partner from the Palo Alto office. I work often with our TTG group, as you will find out, and how that integrates with itself. Work on both domestic and cross-border transactions. I have a split practice in terms of representing venture-backed companies to get self to an exit, but I do have as a really probably part of my practice and my personal preference in terms of transactions is really on the M&A side. Been very active recently, as Chuck indicated, led the transactions on Lincoln Media sale to Hynix, which was its first U.S. acquisition, Mikado Software in its sale right after its Series A, actually at a very nice valuation, to Juniper Networks early this year, and so forth. And have sort of a split between the buy side and the sell side, work with Intel quite a bit in terms of its acquisitions, and the remainder of the sell side transactions. Look forward to joining the talk. Thank you.
Excellent. Well, to kick things off, let's set the market context a little bit. I want to have Christian just take a couple minutes and give us a current look at where we are year to date and your thoughts about where things are headed in tech M&A.
Perfect. Thanks, Chuck. So Chuck asked me to put together a brief overview of what's happening in the M&A market. This is solely an M&A view, not an IPO view. That there's another story there as well, and I'll go through it at a high level. What we've done in these slides is look at kind of where we are year to date historically, but also projected at the current run rate of deals where the year is going to end up, so that's some context on the year to date data. What you see today is that on a high level, the M&A market is flat in terms of number of deals and down pretty significantly, about 28% in the aggregate value transacted. The experience of that is you see lots of headlines in the Wall Street Journal about M&A is down, but the reality is there's lots of deals happening. A lot of what's happened in the declines is not that deals are happening at lower values, because the stock market's actually quite strong and valuations are relatively strong, but many of the mega deals are not happening at the same rate as we have seen in the past. What you also see on a quarterly basis on the right is just a lot of volatility. Values swing around a lot, the number of deals happening in a given quarter swing around. What's interesting also is despite the fact that M&A is down and the volume is flat, venture-backed exits are up in both volume and value. In fact, venture exits on the M&A side have not been stronger in many, many, many years. What you see here is an increase from 545 to 558 deals projected for this year, and a value increase that's a pretty meaningful increase over what was already a pretty strong calendar 11. We'll get into valuations a little bit later, but there's
definitely a tale of two stories between those companies that are venture-backed, have been vetted by the investment community, and those that represent the broader technology market. When you look at, in terms of valuations, the overall technology market multiples are trending around 2 times revenue. The amount transacted varies in any given quarter primarily by the mega deals, where a very large deal can swing a significant amount of volume. We saw that in Q2 2012. But on average, we're seeing about 30 billion transacted so the average transaction in tech is about $30 million. On the venture-backed side, the multiples are about twice as high, and the average transaction jumps around quite a bit more, but generally, again, about 2 times the average, 2 times the median for technology as a whole. And it's what you'd expect. Technology as a whole is many thousands of transactions, everything from bootstrap companies to venture-backed companies. And then the venture-backed ones are those that have been heavily vetted, highly selected, so there's a big selection bias, and you see that in the multiples. What you also see in the market today is that there's an inverse relationship between the size of the deal and the multiple. You can look at the multiple and say, well, venture-backed gets 4 times, or SaaS gets 5 times, but in every single segment, the size of the company dramatically impacts whether it's going to get the Salesforce.com multiple. In the SaaS market today, we've done a lot of SaaS deals at PageMill. If you're a small, subscale SaaS company, the Salesforce.com multiples are just not accessible to you unless you have their growth rate, their scale, their proof of customers. As you start to achieve that, you get better rewards, which is very much why many venture capitalists still chase the IPOs. And then lastly, I think this is the last slide, the dynamic that's happened over time and continues to be a pervasive aspect of the tech M&A marketplace is that private equity is here to stay. They play in a big way. They have lots of capital available. Many debt providers are providing debt capital to these private equity firms to go buy out companies. And what you see here in the data is from a value transacted, versus 05, 06, 07, there's quite a decline relative in the amount of private equity investment. But on the multiple side, private equity firms are paying more than they ever have historically. So fewer deals, more efficient use of capital, higher valuations, in large part bolstered by the amount of debt available. That is the backdrop.
Excellent. Well, thank you very much for that helpful context. And I think to kick things off, I think it would be most interesting to have Nirav and Kapil just share your story about your transaction. And as you reflect back on it now, post-integration, post-transaction, what are the things that kind of stand out in your mind as you went through the process? And just to hear some of that story, I think would be really interesting, and then we can explore some of the topical areas.
Sure. So I'll talk about a near transaction and then the final one that happened. So the near transaction was, I think, in 2007. We were approached by a public company. It's the first time somebody came to me and said outright, their head of corporate development, I want to buy your company. I mean, I haven't seen a stronger buy signal than that, like in the first meeting, right? And so we said, oh, that's pretty good, led to a term sheet. We had interest from another big public company, and so we garnered another term sheet from those guys. And but the first one who approached us first basically was in a rush to do a deal, and so we did a binding term sheet, and we did not use a banker. And I'll get to the lessons learned. Did not use a banker, did not use a lawyer. We said, we've been running this business for 7 years. We're smart enough. We can figure this out, right? Spent a month in due diligence, and at the end of it, they just got cold feet. That's all we got, right? Stopped returning our calls, just got cold feet. So that was a lesson learned. Then in 2010, we felt that the market was ripe, that we were in the app store business. Apple was doing great, Google was doing great, and we thought with a company like us that was profitable, we could find out what the market's like. This time around, we interviewed lots of bankers. We actually hired one. The banker was very good. They actually got us RIM, who we actually weren't in discussion with. We had several large partners, but RIM was a company that didn't know us at all. It just turned out that they were looking for a vehicle like us, and the deal happened very, very quickly. Right. So the lesson learned for me was having a good banker on your side, a very good lawyer. It was a very small firm, but they could handle on the sell side was a very large firm. But they could match them toe to toe with like a couple of guys dealing with 30 people on the other side. So that's my story.
So how many of you know about chips? How many of you are in chip business? Okay, there's about 5 or 7 people here. But,
More than that, yeah.
Okay, maybe more than that. But I happen to only know how to do chips. And it's kind of considered a crazy business to be in. But crazy enough, I said, why not? And 5.5 years ago, I started a company called Silicon Blue. And we made what's called FPGAs, which is really FPGAs are what you may have heard of Xilinx and Ultra, they do that, and Lattice. And we made FPGAs for smartphones, really extremely low power, so you can add new features and functions, new innovation in your phone, such as much better touch interface, antenna tuning required for LTE and things like that. And our largest customer is Samsung. So about 2 years ago, I got an offer. I got an unsolicited phone call, actually an email on a Comcast email address that I'd stopped using years back. and luckily, I still had it on my iPhone, and I never checked that. And it was an offer from an email from the CEO of Lattice Semiconductor, and they said, "Hey, we want to talk to you, and we'd like to acquire a company." So we met. And I went back to my board and they said, forget it, we don't want to sell it, we're going to continue on. But many of you know how the economy has been, and things were tough in raising money, and as we went through our Series D, we really, we squeezed a little bit of our Series A and B guys, and the moment the Series D guy found out that, this was after we closed Series D, that we had an offer, he said, oh, let's do it. And fortunately for him, in 4 months, he tripled his money. Which is fantastic. So the board, he convinced the board that we should go back, and we retained a banker. It turns out it was paid well. And it's not Christian, but one of his colleagues, Nelson. Fantastic guy. And I think having a banker, I concur with Neera completely, is incredibly important. Because you're trying to do something which requires generating an alignment within your own company, your own board, and your own employees, key employees especially, right? Because you need that. Because in the end, you're selling employees, so you need an incredible alignment there. And then you need incredible alignment in your buyer. Even though the CEO wants it, almost everybody else does not want it, because they say, hey, we can do it, and we can do better than they can. So I can see people resonating with that thought. So you have to generate the alignment and get over all those bottlenecks. And your ally in this is your own skills, your own communication with the acquiring company and their management, and most importantly, your banker. Because one of the things that Nels did, who was our banker, who's Christian's colleague, really generated connections well within the acquiring company. Of course, they help you with several other things. We look for other acquirers. So it helps you generate competition, which helps you in valuation. Because nothing else helps valuation than competition. Trust me on that. People say a lot of things on valuation. The companies won't tell you anything unless you have competitors. And so they help you generate other competition. They help you with data room and logistics and many things. But the most important thing that they helped us is negotiating and making and generating alignments within the buyers and of course within the sellers also. So all these things really help. Go for a banker always if you guys ever think of doing this stuff. So that's my experience, and we We sold the company in December, I think I said that, December last year, and I was with that company till August, as I said earlier, and now I am freelancing.
So what was your, in terms of the time from, each of you actually, from the start to the closing, how long did it take?
So you know, all right, so since I got the point. So we got the offer in March, I think the email came in March of 2010. And, but seriously, we went back to talk to them only around middle of 2011. And by the time we closed the deal and, you know, went through the logistics, data room, signing, negotiating, and closed the transaction, it was end of December.
Okay, so 6 months, basically.
So
Okay.
it's a long process.
Yeah.
And oh, by the way, be careful in that process because you then have two jobs. Not only
That's
running
right.
the company,
Your day job and
your
your,
day job, running the company also, because you don't want to have the rest of the company fall apart. So that's what you're selling. So it's interesting. You end up having two jobs at the same time. I think you agree.
Yes, so our deal was 3 months from the first discussion to actually us being on board. RIM was just in a hurry, and they wanted a deal badly. They wanted a better app store, so we were just lucky.
motivated buyer is always a great asset to have. And I would just mention, you know, we have Q&A, but I would love to have people from the audience just jump in at any time, you know, with any of the panel or all the panel. If you have things at the top of your mind, we want to have those issues drive our discussion as we go along. Just talking about the process, now that you've been through this, you're counseling, you know, colleagues in the founder community. You get the offer. What's the first thing you should do? What's the first phone call you make? What are the first couple issues that you got, you know, you should be thinking about for your company, for your employees? What's at top of mind? And then we want to have some of the other panelists comment too. But first, you two guys.
Well, so our first reaction was that the valuation stinks, right? We actually didn't get back to them with any feedback.
This is offensive, man. How can they possibly?
Yeah, like, go away, we're profitable. What are you guys thinking?
Dignified response.
Yes. And so they actually came back to us offline and said, are you guys interested? You're not responding to us. What we were doing in the meantime was getting our act together, trying to rustle up other interests. But I would caution you that you know, any offer is better than the alternative, which is zero, right? So anytime you have interest, take it very, very seriously. And as Kapil said, it takes alignment with your board, with your employees, but any formal interest is to be taken seriously. Then there's the logistics of, you know, we were actually lucky because we had the approach 3 years earlier. We had a data room ready. Do you guys know what a data room is? No.
You got to know about the data room, because here's something about the data room. The buyers, not quite their first, but very close to their first impression and their take on your company is how well organized the data room is. If it's nice, if it's clean, if these guys know what they're doing, they've thought about it. If it's odds and ends, not well organized, and they're going to start questioning the valuation actually. But so yeah.
So just to elaborate, a data room is simply all of your documents collected together somewhere on the cloud, right? All your contracts, NDAs, employment agreements, you know, funding, everything. So if you haven't done it for your company, start doing this tomorrow.
I just want to, one thing that routinely gets left out of data rooms are click wraps. You know, if somebody just clicks through and then never makes a copy. Please copy and put in your files every single contract you enter into, because you will be asked about it later, and finding it 5 years later is really difficult.
That can be very painful. Okay, so have the data room well organized. What about people you talk to? Kapil, you mentioned the alignments internally. So talk about that process a little bit and how you prioritize amongst the key voices.
So that's really good question. So, you know, usually founders and employees' interests are well aligned with the interest of investors. but there are occasions that they are not. And sometimes this is one of those times you can end up in a situation where your interests are not well aligned. And that also translates into your negotiations, right? Because the investors want the maximum, and especially in M&A for themselves. Their employees would want maximum for themselves, but in the end, you have leverages that you are selling, in the end, the employees to the acquiring company. So you do have leverage from that standpoint. But it ends up really being tricky, so communication, constant internal communication is very important. And I spend probably 70% of my time generating alignment with our investors and our employees so that we kept everyone in line. And the remaining 30% time I spent generating alignment at the acquiring company, because there's a lot of managements there that said, oh, we could do this and we could do that. And several of the things, for example, there's several practices you develop as a startup which are frugal and which are easier to do, and most large companies will say, oh, that's really shoddy, or that's not the way it's done, and or this is not the way, we know how to do it better. And sometimes they can leverage that and use that to say, oh, this is not a good deal. So you have to watch that. You have to watch alignment everywhere. And on the issue of data room, I think said that, at least I realized that almost every round of financing you do, you generate all those documents every time. Data room is 2x the work that you do, and that you do in every financing. So it's better to have, kind of like Tessa said, everything, every patent document, every contract, every NDA that you sign, everything, you got to keep all this aligned. Next time I do a startup, I'll keep a data room from day one, so I know everything is right.
It's
there.
all there.
It's all there from day one, so it's kind of important.
Yeah. And Christian and Bill, what are some of the, just in terms of process again, what would you, based on your experience dealing with companies and boards, what are some of the key, you would say, pitfalls to maybe be on the lookout for, to try to avoid and to have, to make sure that the process is smooth?
I think one of the key things is making sure that, we talk a lot about hygiene, the data room. The data room is a place to capture everything you have. I think the things that you want to do is have good hygiene in the company, and that means cleanliness of the contracts. It means having all your employees actually sign, you mentioned assignment agreements. If you have contractors, having those agreements relatively tight so that you own the IP. In many cases, in every case, if you're selling a technology company, the buyer wants to know exactly what they're buying, and what they're buying is clean and transferable. And in many cases, companies are relatively, I would say, sloppy about their contracts. They want a big win with Cisco, a big OEM agreement, and they're willing to have a relatively bad agreement. And that can poison a future M&A sale. So I would say having good counsel every step along the way is well worth its salt. You absolutely need to invest in the good business practices to make sure your contracts are right, that your employees have their appropriate agreements, and that if you're using open source and technology today, that you're using it in a way that makes sense so that you can actually sell your company and get full value for your IP.
Just to close the loop on the VDR, cleanliness documentation and presentation, it is important. I think one of the key areas, in addition to just constructively having something optically full and clean to read and not leaving a bad first impression, is to the extent that you're a typical technology company doing a mid-market deal to a large public company or a larger public company, what they're really buying, unless you have some outstanding net working capital coming over, is really the IP and the employees. So it's really the technology, the intelligence that's coming over, and that's really what they're investing in. So, one of the big things, and I think Tessa will probably attest to this, no pun on words, they're Tessa, but would be to the extent that you have IP assignments missing, from former key technology people, or I did a deal where the company was a product of a spin-out, and while the spin-out technically was done and proficient, it was missing assignments of technology. So there's a gap in time and period where something could have happened to that particular period, and no backdating and no recreation of, particular documents, can sort of justify the fact that it was already done, correctly. So if there's any sort of investment that you need to do in terms of presenting your M&A sort of arsenal to the acquirer, is focus on what's most important to them, which is the IP and the employees, and make sure the IP is tracked. There's an IP title chain, and it's just going to be connected dots. So I would say that's a very important piece.
Yes, right in front.
Hi, my name is Chris Moore. I wanted to really have you discuss the valuation for a second. Both of you had experienced very different transactions in terms of how you were valued by the acquiring company. So I wanted to know the underpinnings of how the acquiring company valued you in terms of all of the tenets. In terms of the technology that you had, and the number of patents, the number of people, the number of business transactions, the number of customers, what debt and financial instruments you were using, equity you were using, and also your previous valuations when it came to investing, so many different parameters and dimensions. So as Christian mentioned about the typical valuations when it comes to venture-backed companies or otherwise, 2.4x of sales or whatever. So I'm curious about the sales that you had at that time, and you waited a certain period before sales got to a certain maturity so as to garner the best valuations possible. So all of the psychology and the tenets and dimensions I was curious about.
So for Cellmania, we were a 10-year-old company, profitable, good revenue, but we got to an acquirer who really didn't care about our existing business. They wanted our technology and our people. So the valuation to them was, we had comps of other existing public companies. We talked about Salesforce comps, we were a SaaS player. But really they didn't care. They said, okay, whatever cash you have, we had accumulated a bunch of cash, so you can just keep it, right? And as far as our existing business to carriers, didn't care about it. So then how do you figure out the valuation? It was just, they came up with a number, we said, double it. We it was basically that.
High science.
There's nothing wrong with that. They wanted us really bad, there was nobody else they could get, so we had our say.
And sorry.
It's actually a very interesting point, right? So, and a point earlier came up, which is, if you get an offer, do you take it seriously? I totally think every offer that you get, you take it very, very seriously, right? So that's one good thing. Especially in today's environment where there's not as many IPOs happening. So it's very important. M&As is all there is, so it's very important, right? Then the question is, how do you value yourself, right? Typically, yeah, they will look at the valuations from the past and things like that, but most of the guys, when they acquire you for two key things. A technology or a product line they don't have, and a timing trigger, a reason for doing this immediately. Especially because it's a tiny little company, they'll say, oh, let it continue on. If it gets really big threat, either we'll make our own product like that or we'll try to acquire them later. So you kind of need that timing trigger very importantly, right? So now you're in a situation where the timing trigger based on your business conditions may or may not align with where you are in terms of timeliness of your exit. And you have to decide, do I really want to sell it at this time when an acquirer really wants me and when my valuation is still not optimal? Or should I wait another year, maybe the stock market will get better, or maybe I'll get another one. So it's trade-offs in life you have to make. In our case, we got more than double of 2.5x, if I may, and I can't give you the exact numbers because they're private, but I think most of the investors look at your, especially if their triggers are dependent on business conditions and timing triggers, then they're looking at revenues and they're saying, okay, this is on the verge of exploding in revenue. It is a competitive threat to us. We want to acquire this before it becomes too big, and we want to position it because it gives us a strategic direction in the company. And so all those events play really hard, And if there's a company that's out there desperately needs you, a buyer in hand is better than buyers, many buyers in the future, I guess. And so it's probably not the most optimal, but the valuation really happens primarily on the revenue multiples, and it may not be the perfect timing for you.
And I think to the extent that you can position your technology as the key building block in that vertical chain that they're seeking to create for the new product family or whatever it is, then they've got that timing pressure. And I think both of these stories illustrate the way that played out to the target's advantage, really, in that process. Now, Kristen, you talk with boards and investors and founders a lot about valuation. So when you're going into a process like this, they've gotten the offer. They think it's ridiculously low. So what are the things that you do to tell that story to drive it up? Whether or not there's an auction, just based on the merits alone.
Sure, it's a great question. I mean, the reality is there's many transactions every year, thousands of transactions, and the likelihood of there being some pretty good comps for any given company is really high, especially when you have, when you look at things at a category level. What are SaaS companies trading today? What are IT security companies trading today? What's FPGA, exits are happening. And so you can look at both public company multiples and private company multiples and use history to inform what's a reasonable range of outcomes. And IT security companies trade at 5 to 6 times revenue, have for 10 years, right? If you want 30 times, it's unlikely that that's going to happen. And so what you can use is just historical data to triangulate and say, what's a range of reasonable outcomes so that we can look at this offer and say, is this high, low, ridiculous, great, and so forth.
And then there's the flavor of the month kind of phenomenon where if you can associate with some kind of cloud application or social, whatever it is, and present yourself in that way with that kind of a storyline. Now, in practice, does that move buyers off of their basically line on their multiple rationale, or what?
It absolutely does. What happens in every M&A transaction is the seller tends to be shareholders. They care a lot about price. It's money ultimately in their pockets. The buyer, if it's a public company, it's not their money. It's on their balance sheet, it's their shareholders. And so they're more focused on what's fair, what's justifiable, and what will not get me fired, right? And not, they're not really motivated to overpay or underpay. They're motivated if we've done 3 deals with IBM, and their job is to deliver the results for the business unit manager. The business unit manager says, I want to buy this business. Their job is to get it done. And so if you can justify flavor of the month, idiosyncratic changes that say, yes, you should be worth more, growing faster, better IP, better patents, better employees, all of those reasons can give you very good cause to ask for a above market valuation.
So Stan, public buyer's range of reason based, I just want to get this done this quarter, what's the fastest way there? Vish has a question.
Yeah, this question actually maybe on behalf of some of the folks I had a chance to speak to earlier. And one of the things that happens, since you all had experience selling your company, and the process and all that, the wonderful personal experience is great, but I think one of the single biggest factor, that a lot of entrepreneurs need to consider, when do you decide, what is the boardroom deliberation that goes on that, hey, now we have to sell? So whether you engage a banker, of course you got to get lawyers and all the other accountants, they kind of come in the process, data room. But I think for the entrepreneurs, so what goes on? So could you guys comment on that? How does that deliberation take place? Because I know lawyers you guys are a very integral part of the deliberation. So
what's the right time?
Yes.
And how do you figure out what the right time to sell is?
Well, so, if somebody wants to buy you, that is the right time.
Let's assume there's no offer
So-
yet. Let's
so in our
assume you're
case-
looking out,
So
6 months to a year.
As I described, in our case, the first time there was an offer, so we looked at it. Second time there wasn't an offer. We said, look, we've been in this business 10 years. The markets right now look as good as any. Application business is very high. The markets are in a good mood. And we just had a gut that there's got to be a buyer for us.
Now that gut, were you driving that dialogue, or was that, sort of an interactive between you and the board? Who sort of, I assume it was you.
It was I have a co-founder, and through our own investments, we had invested a lot in the company, so we basically ran the board, which is not always the case. So it was an easy discussion between us. We would discuss this for 10 years between us, every day. And you as an entrepreneur will see when the markets are right and when they're not. Sometimes the markets just close. And when the market opens, guys, it's a very short period of time. It's a very, very short period of time.
So can I?
Yeah, please.
It's an interesting thing, right? So there are several timing factors you're dealing with here, right? First is most venture capitalists run on 7-year cycles, so they've got to give some returns or some may be variable, but that's really what you're looking at. And the kind of business I was in, or I am in, is chips, which takes several years to build. So we were 5.5 years, I should say, around. So that's the second timing you got to look at, right? The third timing you got to look at is where the capital markets are and where your next round of funding is coming on. Especially if you reach very close to break even, you don't worry about this.